Hello everyone. So as we all know, Google did an equity raise during the week. So in today's episode, I'll be talking about 4 different pieces of news as well as themes that I find compelling in the markets today. Okay, so let's start with this entire slide deck here. This was actually made with the courtesy of Gemini. So here are 4 high conviction themes for the week, as well as my thoughts on some news articles like the Google equity raise. Okay, so we'll start with the Google equity raise. So if you didn't know, Google during the week, they actually did an equity raise. So they're basically diluting existing shareholders by about 2%. And a portion of that was actually sold to Berkshire Hathaway at a discount. So there are multiple different perspectives in the markets today. I'll lay it out right now. So first of all is that your IPOs will actually soak up capital from the markets. So what Google is trying to do today is to do a capital raise before your IPO suck out all the capital. And then of course, there's another perspective as well, which is that there's weakening credit signals, which is that raising capital in the credit market is a lot tougher now. And then third of all is this perspective by Google's team, which is that they're getting to the point whereby they cannot leverage more, because they feel that the AI ROI won't be as predictable as what they thought it would be. Because if you're to do a debt raise, then of course there's a cost of capital on top of that as well. So that is another perspective that you can try and take. Of course, there's a last perspective as well, which is that Warren Buffett or Berkshire Hathaway is actively trying to enter and buy more Google shares. And that is why Google is doing this equity raise over here. Okay, so for Google, I think my general thoughts are over here. So first of all is that Google has the entire full stack. For example, if you compare it to your different hyperscalers, like for example, Amazon, Microsoft, or your research labs, like for example, OpenAI as well as Anthropic, none of these companies have everything together. Like for example, in the case of Amazon as well as Microsoft, they don't have a reputable frontier model. In the case of Anthropic as well as OpenAI, they don't have the cloud computing services and infrastructure that is needed. So in the case of Google, it is the only AI company out there that has the entire full stack. And second of all is that Google has this distribution mode that no other company has. So they have the B2B channels, they have their B2C channels as well. And if you think in terms of AI, what exactly are they building towards? And if you think about every single investment, it should always come to a point where you're able to commercialize it. And in order for you to commercialize it, you need the distribution networks for you to do so. In the case of Google, it is a company that has dominant distribution channels. You have your consumers, you have your enterprises, all using Google products. And I think there's no other company in the world that is able to replace Google. So that's just my general thoughts. I think the equity raise is a signal from management team that they feel the stock isn't exactly cheap. But for Google, I think my general thoughts are that this company is just incredible. Okay, so if you're to extrapolate what you have in Google, which is the entire full stack, the entire vertical integration that the company has in terms of AI, and you bring it over and think about what other companies has this ability to fully integrate everything. You think about China. China is the only country in the world that thinks ahead of other peers. China is one of the countries that really focuses on vertical integration. So if you think in terms of a governmental level, they focus fully on vertically integrating everything so that they have their own sources, so that they're not dependent on external countries like the US or even the UK as well. And if you go into the individual companies as well, what you'll notice is that the companies try and adopt a very similar principle as well. So what they will try and do is they'll vertically integrate everything. Like for example, BYD went from manufacturing the batteries to manufacturing your cars. In the case of your cloud computing companies in China, Baba, Baidu, as well as Tencent, ByteDance as well, what they have tended to do is to vertically integrate everything as well. And I think Baba is a very similar example to Google. They have a vertically integrated full AI stack. And second of all is that they have the distribution channel for them to do so. So as you can see over here, Chinese tech ecosystems represent the exclusive alternative geography possessing frontier models, high performance cloud, and native silicon chips. And second of all, we highlighted this earlier in our Substack as well. Feel free to check it out. It's the link in the description below. But if you're to compare your US token cost as compared to your China token cost, your China token costs are actually a lot cheaper as compared to your US, despite being of a similar performance level as well if you're to look at your leaderboard. So for example, in the case of Alibaba, it is actively being used by Airbnb for customer service. And so there's a massive discrepancy in terms of pricing there that your Chinese companies can leverage on. And I think China, in the case of Alibaba, has done so as well. So they have recently just raised prices quite significantly. And although competitors have have reduced prices for their tokens to try and gain more market share, Alibaba has stayed firm on their token costs and has increased prices for their hardware products as well as their software products. And yes, for Chinese companies, of course, there are regulatory problems as well, like what we saw with Futu, with Tiger, and with your Longbridge as well. But I think your Chinese firms have an untapped narrative that hasn't played out yet in terms of the stock price. And for a lot of these Chinese companies, you're effectively just buying the cash and waiting for the AI story to play out, basically buying a call option for that. So for example, if you were to look at Pinduoduo at 60% cash, if you were to look at Alibaba as well, do a sum of the parts with the investments that they have as well as the cash, it's around 30 to 40% of their market cap in cash as well as investment securities. You look at Tencent as well, it's a very similar picture. If you net out all their investments, the price to earnings of their existing business is around 12 to 13 times. So you're basically just buying and waiting for the entire narrative to play out with downside protection as well. So I think although your Chinese companies are hated right now, it's an opportunity to bet on a narrative that hasn't played out. And I think the price increase from Alibaba is a strong signal that it is not something similar to what we've seen in the past, which is a race to the bottom. Okay, so this is a very interesting theme that I think hasn't really played out yet as well. So energy, as we all know, this year has gone up by quite a fair bit because of your Iran war. But valuations in your energy industry is still relatively low, and energy as a sector as a whole is still underweight as compared to your other sectors. So I spoke to someone that was previously working in semicon, and this is what he told me. So I asked him about his perspective on the bottleneck. So your semiconductor bottlenecks, and this is what he said. He said the bottleneck is likely to be in energy. And so if you were to look at the energy sources, like for example in Singapore, it is LNG heavy. If you look at China, it is coal heavy. And if you look at the US, it is relatively fragmented. So you have oil, you have LNG, you have renewables, you have nuclear as well. And so I dug a bit deeper, and this is what I found as well. And so if you were to dig a bit deeper, what you realize is that the reason why your turbine companies, like for example GE Vernova, Caterpillar, has gone up so much this year is because it is an actual bottleneck. Why is it an actual bottleneck? Because all your energy sources, like for example your oil, your coal, your nuclear, all of them will need a turbine in order for you to turn the heat into electricity. So the way to think about it is something like this. You have your oil, and then your oil goes into something called your reciprocating engine. And then after that, it goes to the turbine, which then goes to the transformer. So everything will require this thing called your turbine, which is why companies like GE Vernova, Caterpillar, as well as Mitsubishi, I think heavy industries has gone up by quite a fair bit because of your entire AI build out that requires so much energy. And so there's a different play in this entire sector that I've been looking into as well. I'll release a Substack article if I find a company interesting. It's the link in the description again. But this company is called Baker Hughes. So Baker Hughes has, I believe, around 30% of their EBIT coming from their turbines, which is under this IET segment of the business. They have many different types of turbines. They have the smaller turbines, and it is the premium version as compared to your GE Vernova. Same thing, it is very predictable, recurring revenues coming into the company. The company is up around 40% year to date, tied to this narrative as well as, of course, your oil price increase. But I think there's a structural change coming out from Baker Hughes, and it's a really interesting company that you can look into as well. So in summary, your turbine crisis is real. It's a toll booth for your entire energy bottleneck if it plays out. And a company that is interesting is Baker Hughes. Feel free to check it out. Last theme that I'll be covering is on sizing as well as long tail risk. So I was actually asked in the Telegram channel how to size your position, how to think about allocating your cash, you're allocating your different positions. So there are two different camps to this. Of course, you have one camp which says that concentration is key for you to achieve superior returns over time. But I take the opposing stance right now. I think over concentration is something that exposes you to long tail risk, exposes you to excessive downside risk if an entire sector is whacked. And then, of course, you have the over diversification as well. If you over diversify, then what happens is you're just tracking the markets. You're not going to get alpha ahead of the markets. So as you can see on the slide over here, concentrating heavily on a single sector or a macro theme is incredibly powerful on the upside, but can be financially lethal on the downside as well. Accommodating the unexpected is important because long-term events, unpredictable regulatory pivots, geopolitical shifts, or sudden liquidity shocks will happen. Dynamic position sizing is important. And then third of all is that active risk management means shifting allocations into uncorrelated value cash cushions like China, for instance, or physical infrastructure, ensuring long-term survivability. So yes, extreme concentration is good if you can hit the darts and then get it right, but most people don't get it right probabilistically. And so a risk managed sizing plan is more important. So yes, I can raise one example of this risk managed sizing plan. So there's this fund manager, he runs a fund, and what he does is that he splits the entire stock market into a few different sectors, and then he equal weights them. So let's say there's 7 sectors, and then he equal weights them 10%, 10%, 10% each. And then he has this 30% remaining, and what he does is that he spreads it out into whatever he feels has probably the most momentum or the most undervaluation relative to the other sectors. So that's one way for you to size your position. For investors in general, I think there's something interesting that you can look at, like for example, your Kelly criterion to look at how to size your positions. For me personally, what I try and do right now is to not go above 5 to 10% for a single position. So of course, you can let your winners run. But yeah, over concentrating in one single theme is not what a portfolio manager should do. But of course, this is something that's not really talked about amongst retail investors. Retail investors are taught to concentrate into strong positions in the quality companies, but you can get killed on the downside if it's not handled right. So this is the summary for today's episode. First of all, is that position sizing isn't boring. It's how super investors protect against structural volatility while reserving cash to load up on generational opportunities. Second of all is that this company is interesting, Baker Hughes. I'll release a write-up if it's super interesting. Third of all is that your Chinese companies are cheap. And yes, extrapolate from what Google has done very well, which is to vertically integrate everything. Only your Chinese companies have been able to do so. And last of all is that thank you so much for watching this video. I hope you guys have found this video useful, and I'll see you next week.